All right. Good morning, everybody. Got a mixed bag. Uh, Markets are fading back a little bit. Hong Kong up the most, 1.8%. Japan down 0.5%. The Dow in the red, small caps at 0. S&P up 0.25. And the NASDAQ up 0.75% this morning. Europe is down. It's kind of the highlight of it all. We do have PCE today. It's going to be the biggest thing on the docket. It's at 8:30. You can see on FX Street the high impact anticipated. Now, it is possible that the University of Michigan inflation information is going to also be a little bit of a rock the boat. There's the spot gamma levels for today, and as usual, I'll mark them out on a chart and post those. But still, if you want to screenshot and do it yourself, there's the SPY. Or for you NQ futures traders, or the NASDAQ. The volume is right about where we would expect it to be. It's at its average. There is a market maker move this morning showing some hedging activity in the front end. It's interesting that we're getting the volume that we are and the hedging. Usually we'll get the hedging and the volume will be a little light, which makes sense. They're sitting out and they're protecting their bets. But here we're seeing both. They're protecting their bets and they're in their trading. We have just gone through the open, at least on the S&P. The NASDAQ's nowhere near that point. And right now the target would be back to yesterday's close. We've got a gap below and a gap above. So surprisingly enough, we can actually close both sides today. That's the market, right? That's the way it is. So looking at it on the week, we are definitively down below the moving averages. There's no doubt or confusion or hesitation to this. And the trend is dominantly to the downside. Now, a lot of places will put a stipulation on how far from the highs we are. If we're down 10%, then the market is considered in correction territory. That has a lot of weight to it. You can actually Google it and see what that means. There's a historical precedent behind how far down we are. So we are in correction territory. How we close this week has some weight to it, but how we open next week is going to be just as important. So, it's kind of the idea between a gap up on Monday versus a gap down on Monday. Just a second. All right, sorry about that. So that's what we're going to be watching for next week, is how we open. Otherwise, we want to continue to press the shorts unless there's some sort of interference or, subtle little assist from something somewhere, then this move to the downside is what we've got. It's likely to continue. So let's just discuss that a little bit. If we get a little wild today, how low could we go? Right? There's an old music. How low can you go? The put wall is 41.16. It's kind of moved down a bit from where it was at that 42. We got the COG line at 41.11, the ADR half 41.35, a full ADR way down here at 4100. We would take this market maker move and we would go even lower than that 4103. So it just roughly down to 40.85. We could go down to 40.85 and it wouldn't even be considered an outsized move. That'd just be another day at the office. Just use a round number 41.85. Now that the market being what it is, looking at the market maker move from a single direction doesn't really make sense. We could go all the way down there and then we could come all the way up here, or vice versa. We could go all the way up and then go all the way down. It might seem a little unrealistic to believe that we could go both directions in the same day, but we've done it before. We can do it again. So we want to look at the high end of the ADR levels. We've got 4,200 for the ADR half, 4230, which is a COG line at the 4230 full ADR level. And from that, we would add another 44% or 0.44%. That actually gets us up to the 10-period moving average. So we'll just use that. It's 4250. It's a nice round number. It just fits really well, right? So we'll do that. It's always nice when your levels line up with other levels. That's a pretty wide range when you think about it. So the put wall is at 4120 or right around in there, very close to it. The vol trigger and zero gamma is in the 4300 area. That's a long ways away from where we're at. So until we get back up there, the idea is we want to continue to focus on high volatility situations. So no butterfly trades and things like that. Butterflies don't do good for pinning strategies, right? Pinning strategies don't work good in a high volatility environment. So we're going to get that thing out of the way because it's just a very loud indicator. Get rid of my lines here for a minute. Now that we've gotten rid of some of that stuff, we can see where the daily pivot point is at. And we've just cut back through the pivot point. We had barely touched it before, which might have gave us an argument for an MDP, but not now. We've definitively resolved that. The weekly pivot point is a long ways off. Generally speaking, when we get too far away from it, we tend to go back towards it. But that's a bit arbitrary in nature. How far away is too far before we have to consider it? There's not a really good answer for that. I don't have one. Unlike the distance from 10 indicator that I have built and that I use, the weekly is, I just don't have numbers on it. I don't know how far away too far is, but generally speaking, I would say we found it yesterday Now, what we've seen before, when we get this distance away from that weekly pivot point and we get this kind of behavior where we try to run back to it and fell back again, it's almost like it gives it permission. Isn't exactly the right word, but I'll use it. It's almost like it gives it permission at that point to extend even farther away, like another leg down. So I want to focus on that. Any moving average that we would want to look at is over our head. So the 10, the 20, the 50, the 200, everything is above, except for that weekly 200. But we're just talking more about, like the daily. Even on the weeklies, everything except the 200 is overhead. So any move to the upside is going to just be a real difficult slog, right? So at this point, we are building a little bit of a Haramni. We don't have it yet. Or maybe above the stomach. Belt hold. We need more candle, right? Okay, so we're starting to lose that B shape that we had, and it's starting to just turn into a big cluster. But what we might end up with is a capital D. Throughout the day today, we're going to continue to lose more of this volume. You can see that we've brought the point of control down, as I had discussed yesterday. But we're losing that classic B since we started to develop a lot of price and volume around the 4180 area. Too many lumps. So now this is going to be the area of focus. It's going to be a difficult time getting through that 180, but if we can, then it's a shallow run back to the point of control, 4260. It's a nice 80-point run if we can get through the 4180, which is a big if at this point. We don't have a VPOC to carry forward from yesterday. We've run through that zone so many times last night that it has no weight or value. There is a lot of volume down at the 4159, 4158 area. So if we get to this gap close, I would expect that to provide, say, a first touch rejection play. There was a lot of trading activity that was done here yesterday. The idea would be that if we get back into that zone, there's probably a lot of traders willing to do more trading at that location. That makes perfect sense. So it's not support per se. It's just an area where we expect unfinished business to step up. More trading at that level. If we do get through that zone, there is a VPOC below that at 4123. Now, as a reminder, that's an old VPOC level from the September contracts. I believe it might be even farther back than that, but either way, it's not the December contracts. And so we have to kind of believe that any unfinished business that was there is now just not there because, well, those contracts don't exist anymore. We are 2.5% away from the 10-day moving average, and that's just about the sweet spot. We have expanded farther than that back in, say, August, September into October of last year when Powell did that Jackson Hole mic drop moment. But other than that, we haven't really seen those kind of extensions, and unless we go back even farther, say into June, when the market was just in the throes of the most negative media about inflation and how bad everything's going to be and guaranteed recessions and blah blah blah, and market was really biased to the downside. So sure, we've been lower than 2.5%, but for the most part, this is where we would generally expect the market to pause, to consolidate, to give the 10 time to catch up with us, or to turn around and go back towards that 10. This is the 10 that we're talking about, right? Just to put a nice little visual edge on it. We're talking about how far away from this 10 period moving average are we? So when we look statistically and historically, when we get too far away from the 10, we tend to come back to it. Here is one of those times when we really drove away from the 10, right? And then we came back to it. And here, deep drive away from the 10, we came back to it. It's just like a mean reversion play, right? But there's times when we get all blowed up and we stay driving farther and farther away from that 10. But you see how it pauses, gives the 10 time to catch up, makes another leg, pauses, makes another leg. So same thing, we drove to the downside, we paused, we drove to the downside, we expect another pause and or a reversal back. It doesn't owe us that, right? We could just sit down here and digest, give that thing a little time. We are outside of the weekly expected move. Let's put that back on the ES. So yesterday, the ES went outside of the weekly expected move and we pulled back inside the box. We've been out of this box multiple times in the last 10 weeks. It's how we count to define, what's the accuracy of this thing right now. It's supposed to be, as a one standard deviation tool, 70%. But on the S&P, it's actually more accurate than that. It just historically, it has been more accurate, but we are measuring a one standard deviation. So it's 68 point blah, blah, blah % that we're supposed to close inside the box. Right now, it can't even close 50% of the time inside the box. There is a stipulation to that. I don't generally count holiday weeks. So if we eliminated this week that we closed outside of the box, if we took that one off the table, then it's not 50% of the time, it's at 60. So, that's pretty close to the one standard deviation that it's supposed to be. But the main takeaway is that right now, either A, the market makers are underrepresenting volatility, and I don't think that's the case. Two, the volatility isn't pricing into the options. So options volatility is derived by the options trades that are taking place, right? How frequent the trades are, if people are hitting at the ask and above, at the bid and below. These are the activities that change the implied volatility on the options themselves, and it's those options that derive this range, right? So if they're not being heavily traded, then the data is weak. The lines are, indistinct. The ranges get broken easier. That actually fits my logic and scenario of this situation more than the market makers getting it wrong. The takeaway, though, is that if we miss once in a while, it's not really a big deal. It happens. But when we start getting consistent misses again and again and again, that it's a warning, not just on this market, but the broader market in general. You want to avoid doing iron condor strategies right now. You want to avoid any pinning strategies like butterflies. Definitely don't want to be selling credit in the short duration. So, use not 0 day traders, but, week to week credit spread sellers using next Friday's levels, that kind of stuff. You want to proceed with absolute caution right now. It's, you're not getting enough money for the risk that you're taking. All of that just from the idea that we continue to miss this box, right? And in the broader things that we look at, people used to tell me that there was no warning when COVID hit. That wasn't true. There was plenty of warnings in the market that something was wrong, because COVID didn't hit all at once, right? It started popping up around the world, and then it got worse and worse and worse. And there was warning signs in the markets themselves that there was something bad. We just couldn't see what the bad was, right? We didn't know how bad it was going to be. If you go back to January and February of 2020, before COVID hit, we started coming out of the box and breaking the ranges and the edges more, closing outside more and more. That was one warning. Then there was skew, which is an actual derived chart. You can, type in skew and go to the skew chart. So there's a number of factors. Skew is tied directly to optionality too. So then there's the VVIX and the VIX itself. So all of these things are just warning signs that something is wrong, something's off. And, we can't always put our finger on what it is, but we can recognize that something just ain't right, and that's where we're at, and something ain't right. So it's a note of caution. If you are looking for new trades, and you're thinking it might be a good time for some bottom fishing plays, and you're wanting to maybe pick up some mutual funds, and I'd say be ready to hold on to those for a while, because you go loading the boat here and we leg down another 250 points, you're going to be holding on to that stuff for a while just to get back to break even. All right, the trend is dominantly to the downside, and we are in correction territory, and we have these optionality signals saying that there's something wrong, something off out there. Volatility is like getting suppressed or muted, or it's just not coming through. A lot of different reasons for that. There's no reason, to be conspiratorial and put the tinfoil hat on or anything. Just there's all kinds of vol suppression mechanics that inadvertently happen, right? Not even like somebody's out there doing something. 4160 is where we closed yesterday. It's the expected target in this move. I mentioned that a few minutes ago. They're trying to bring it up, trying to save it from that drop, but that looks like a fair target even now. Don't see anything that's changed on that. The interesting thing is, though, that for the SPX, it doesn't look like we're going to be opening gapped up, which is what we were looking at, was a gapped up market. Instead, now it looks like we might be opening gapped down. And I got to tell you, I don't mind that even a little bit. I would rather have a gapped down market than a gapped up market. It's my own bias, I know, but that's what I would like. Just recognize, that for the last 2 days, we have gapped down. There's nothing to the magic of counting down days, 3 down days and then we bounce, 3 down days and then we bounce. Oh, it's magic. Not really. Just because we're looking for it. Plenty of examples where we had 2 days down and a bounce, 1 day down and we bounce. So, it doesn't owe us anything, right? But there is a setup that I like. And it's a setup where we open gapped down and everybody's crazy bearish and, Bloomberg and Seeking Alpha, and everybody's just telling us about how horrible it is out there. And we open gapped down and we dip just a little bit more. And then they rip the Band-Aid off and we run to the upside 120 points. I don't know that we're going to get that today. Just throwing it out there. All right, we're looking at the dollar index here. This is the DXY. Put it on a weekly, and we can look at this and say, yeah, that's not bearish. It's not bullish at this point. We're stalled out for the 4th week now. So it's been a month sitting at this level. But the thing is, honestly, that really is still bullish, because the longer we hold this high, the more likely it is that we're going to break that high and continue to the upside. We've been stuck underneath this halfway point, right? It's a half back level. So that's what we're focused on is, are we going to get through this halfback level or not? And we got to think about, well, what would that look like for US dollar Japan? The Dixie is the first part of this pair, right? US dollar Japan. So we get that drive to the upside through that halfway point. What happens here? Or, what happens with Europe and China? So it's a really big deal. It's not just, how's that going to affect our markets? It's how's that going to affect these other markets? And right now, Japan is the biggest threat, right, to anything. If they come out with global intervention, global support in their intervention, like they did last time, the S&P is going to rip to the upside. A good 6% is what we did last time, 6% in like 4 days. 1.5% in 1 hour. It's a fantastic move to the upside. So that would shred anybody's short trades. So if you're heavily short, that's your biggest threat right now. But we can't sit around waiting on this US dollar Japan threat. We just have to continue to watch the dollar. It's that 107.17 level that we got our eye on. That is October of last year, by the way. If you kind of want a gauge on where was the dollar when Japan intervened, it was right there. And what happened to the dollar? That's the wrong year. Let's back up. I was thinking weekly. Let's go to 2022. There it is. June, July, August, September, October, right there. This is where the dollar was last year when Japan intervened. Right there. And that's what happened to the dollar in the next 5 to 6 days. We dropped, call it 114, down to 110 in a week. So we want to keep our eye on the dollar, want to see what happens here, whether or not we break through that 107. The idea is that if we get through the 107, we're very likely going to go up very fast, just like we did back here when we were just marching to the upside relatively quick. That's the idea if we do cut through this. And that is like a textbook bull flag too, right? All right, the idea with gold is going to be that if US dollar Japan does intervene and we see the pair fall and US dollar Japan fall, is we're going to see gold go up. But it has to fall first, right? Otherwise, if it continues to go up, we're going to see gold fall here. This is an inverse product, right? So the more US dollar Japan goes up, the more we expect this to go down. All right, nat gas on that breakout that we've talked about before, it pulled back, got that recovery pullback, and what a move, right? The halfway point, the halfback held. We want to project 50%. That's 3.78 in nat gas. Now this is the futures product. Most of us aren't trading that, right? So you can go something like UNG. It doesn't look as good, right? It's still clustered underneath all this trash. There's a couple of ETFs and other, companies out there that are heavily vested in nat gas, and that's kind of the suggestion, right? If you want to trade nat gas, don't trade UNG. It's kind of a turd. Look around for an ETF or one of the companies out there that are vested in nat gas. I believe LNG is one of those. Don't quote me on that, but you should be able to Google it, right? Shouldn't be, it's not some big mystery. All right, Bitcoin got into 35, and then it was pulled back a bit. 35.2 is what it actually made it up to before it pulled back. There was some talk about how the news that popped this up there still hadn't been, it was a lot of speculation, right, about this new ETF and whether or not it was going to get approved and blah, blah, blah. The idea is that this push probably wouldn't last, but look at how we've been doing since 2023 began. We are setting higher lows and we continue to set higher highs. So as choppy and as difficult and as nasty as it is, we do continue to drive higher here with these TRB setups. Love that TRB setup. You see that one candle, baby? That's what it's all about, right? That's why the TRB is so fantastic. That one candle. Still not safe to go long bonds. There's nothing in here that says that this move to the downside in bonds is done. We've had 1 week to the upside and we're down this morning. But you can see many examples where, we had 1 or 2 days up and then we just fell and continued to fall. And there's still nothing here that says we're done. So the expectation is that we're still going to continue to fall. We had a really big week last week in the TNX. We are at the 50% mark, right? The halfback level, but it's holding so far this week. You got to admit though, in the bigger picture, while this does look bullish overall, that is a distinctive topping pattern, right? And the fact that we got that lower high there is a first start. If we break this low, then we've got the start of a short-term topping pattern with a correction, right? Because you get that move to the upside. And when it pulls back and then it fails to get that new high, and then we break that low, that's what we're talking about doing here. Then we'd want another lower high, and we'd want to break that low. So right now we're at this point, whether or not we're going to break that spot. So TNX closing below 4.831 is going to be the start of that, but keeping it on a weekly, this still looks really bullish. We've had 1 or 2 weeks where we pulled back a little and then we just kept right on going. A down week, kept right on going. That hasn't changed yet. Even with a week to the downside where we closed lower than the previous week and it still didn't change anything. We just kept right on going to the upside. So this 1 week down, that's nothing yet. You want to kind of get an idea of, well, how bad could it get? There's the TNX at 16.15. We haven't even begun to see what bad looks like yet. %12 of the S&P is down 0.5%. 8% of the NASDAQ is down 0.5%. %17% of the NASDAQ is above 1%. That's pretty bullish. I mean, it's not like wow bullish, but 17% is up more than 1% this morning in the NASDAQ. And where do they come from? Semiconductors. Nearly half of all the names are semiconductors. And then you've got things like Tesla, Amazon, CrowdStrike, Trade Desk, Intel, and PDD, not to be left out, a little China ADR in there. %7 of the S&P is up 1% or more. And a couple of them are FANG names: NVIDIA, Tesla, AMD, Amazon. Thing is, some of this is earnings. So an earnings pop doesn't normally have enough gravity to move markets. The main thing here is that there's no theme really shining through. Nat gas is up the most. KWeb right behind that with the China ADRs. Things like Baba, Baidu. Yeah, look at that. Pop and it's keeping it. PDD, JD, things like that. So that's all part of the KWeb constituents. Then we've got crude like USO. We've got the FXI, China large cap, getting some moves this morning. Semiconductors through the SMH, uranium, more energy with oil and gas exploration. Of course, we got some earnings that made that one move. More emerging markets, which is basically China. And that's where our benchmark ends, because we use 0.5%, right, to see what's moving. So that's a pretty broad market dynamic, but it's not enough, right? That can't move markets. That can't sustain the market. Let's say that. That's a more accurate statement. What we don't have, the pot stocks, the Bitcoin stocks, we're not seeing those up this morning like we had been seeing. This is more of a growth value dynamic. Thing is, I don't trust a market rally that's leaning on China ADRs to get it done. So the FANGs can do it if they come in there together and all start working as a team, but right, that just kind of sums it up. But so here's the NASDAQ. It's the NASDAQ 100. The size of the box represents market cap, so the FANGs stand out relatively easy. Tesla, Amazon, Apple, NVIDIA, Meta, Microsoft, Google. They're easy to see because their boxes are really big, right? So we can adjust the color scheme here a little bit, make it a little more responsive to how soon it changes. The green is minimal, a little bit in communications and utilities, producer manufacturing, but otherwise, even in the chip space, I mean, sure, there's a couple down in here, but the big dogs, we got nothing. Microsoft's down 3.75%. That's close to a 4% Microsoft drop. Apple 2.5%, Amazon 1.5%, NVIDIA 3.5%. Those are some solid negative numbers. So, you know, what are we going to see this thing turn around? Not with those, right? Though we can't turn around and go up. We can't if these are going down. We could do it if these weren't going sideways. You know, if they were sideways or going up, we could do it, but not if they're going down. So how much more down can we go? Well, they got a lot of room here, right? And we covered that. A full ADR and then put the market maker move on it. And that's a bare minimum. If you want an extreme day, double the entire range. That would be the start of an extreme day. That wouldn't cover everything. So this is the range. Yeah, nailed it. That's the range. We can literally just take that and do that. 40.39. It's a little bit of a ballpark number because I didn't put the market maker move on there. We'd actually expand that another 0.8%. So even lower, pretty close to 40.11 cog line down here. And we could do that today, no problem. And if you're thinking I'm reaching, I hadn't even begun to reach. That's nothing. Everybody, enjoy your day. Have a good weekend, and we'll see you next week.